All right, welcome everybody to the Strategy of the Week webinar here for March 3rd, 2022. I'm Dan Hussey with Zaner Ag in Chicago. Remember, trading futures involves risk and not suitable for all investors. And everything here I talk about today is just my own opinion, not a direct trade recommendation. But that doesn't mean that some of these ideas can't be turned into, direct trade recommendations and strategies. Working with my clients is part of the process in developing that trade plan. You'll see uncovered here today in this video, in this webinar. So thanks for joining me. It's been a wild last week since the Russians invaded the Ukraine. What started off as what could have just been a diplomatic issue has now become a full-blown conflict for the region. It is really, I think, being shown, I should say, in the markets through the moves we've seen in wheat. With the Ukraine and Russia accounting for about a third of that world supply of wheat production, that all of a sudden is now in jeopardy, and the balance sheets are going to need to be adjusted accordingly. We have massive production for still, kind of unaccounted for, and that's not even beginning the discussion about what we might need to walk back on the acreage or the actual production numbers here for South America still. But Russia and the Ukraine this next planting season doesn't look like we're going to have much in the way to count on for acreage from that Western Europe or Eastern Europe region. So that being said, wheat today trading limit up. Really, I think stole the show. We're gonna have expanded limits again tomorrow. Synthetically here today, wheat was trading. Let's pull that chart up of Chicago wheat here while we're talking about it. Chicago wheat was trading synthetically at one point at $13.40. That would be $2 above the limit here today in the call options. It was hovering really around $12.40, $1 higher from where we limit up here was today. So wheat synthetically was giving absolutely no opportunity, even via the option markets, for traders to get out of this to the short side. So this is a powerful move that I would not stand in front of. This is not the time to get cute. Buying puts have limited risk, but even the puts, as we will take a look at here, let's begin the discussion there, because the focus of today's webinar really is, how do you trade in this type of volatility? What are the types of strategies? What are some of the ideas you can put out there that have limited risk, even though the cost might be a little higher now because volatility premiums have been baked into option pricing now. When we're moving around as much as we are, crude oil is making $10 ranges. Soybeans are moving 50 cents up and down without a problem. Corn and wheat are going limit moves, and equally erasing those limit moves in overnight sessions. We saw 2 days ago with wheat. We really do need to. You have to, trade something, or trade in a way, in a capacity that is manageable. And outright futures actually end up putting many traders, even marketing, those doing so for hedging and marketing purposes. It even puts futures out of the equation for you at this time, just because they are too high risk to hold in the portfolio with the amount that we're moving. And that is, of course, assuming you're not already positioned in a winning trade. If you're long wheat futures or any futures in the row crops at this point and deep profitable, that's not what I'm talking about. I'm talking about trying to get in on a new trade today from a flat position, or trying to utilize futures, outright shorts in this case, for marketing professionals to try to sell the board price is not advisable in this type of environment. It's a good way to have to feed the margin beast and find yourself in a position where we're limit up moves like in wheat, where you just cannot get out if you want to. All that being said, I brought up the wheat options here just because I wanted to show how even the puts, I'm going to get the strike a little bit bigger there, how even the put side here is, incredibly expensive. 1070 put, that's out of the money. Okay, it is basically lows of today. If we bring up the chart of daily 4-hour chart of wheat here, lows of today here at 1070. That strike, it traded at 75 cents last. It's $1. It's 60 cents out of the money here from today. But the market has so much risk premium built into that because of this volatility that they're, market makers are demanding you still pay up a pretty penny. That doesn't mean that you can't utilize 1070 strike in some capacity. I, as a market strategist, would look to my client who wants to buy a 1070 put and say, okay, maybe there's a way we can help pay for that. Limiting the cost of that, option is another avenue to go down, and that can be done by selling an option strike below us. A lot of these prices you see here, we don't have great bid offers in, but at the cost of purchasing the 1070 strike, we can look $1, maybe $2 lower, and still bring in decent premiums here for options that can turn a long put into a put spread. It limits your downside protection if you're using this put as some kind of floor to protect either production or just have a downside look at the market. You are limiting that downside, but you're bringing in premium that's also limiting some of that exposure to that volatility premium that's built into the market, and of course time value at the end of the day too. So if there's a price below us where we're happy to buy the market, that's where we can sell a put against a long put to have a put spread on to try to capture that type of or that distance or that move in the marketplace over this period of time. So not an actual trading recommendation or an idea, just hey, look at how expensive options have gotten. Even puts in a limit up type market have a nasty taste to them, having to spend what the market wants to demand for them. But that's the nature of the beast. Talked about wheat here. There's not much else to say about the chart. Moving averages have been left $3 below us. We have moved $2 higher in the last 3 days. We have limit up 75 cents in expanded limits, and we are trading. The only news to report today is that we were trading synthetically still $1 to $2 higher, suggesting that we'll be possibly even opening at limit up this evening at the reopen. Look for that. I wouldn't be surprised based off of how options traded all day today that would be the case, that we just go limit up and stay there. We might back off that limit. Who knows? The overnight volatility has been extreme. And let's take a look at a 15-minute chart of wheat real quick, just to get an idea of what I'm seeing there, and what's possible in this market. All right, really, I'm just looking back to yesterday in this 80-cent slide off of limit up that we had. Completely possible in the illiquid overnight sessions. So unless you're willing to accept 80 cents to a dollar of risk trading a futures contract, wheat and many of the row crops you have no business being in futures at this time. My opinion, but as a broker who tries to help their clients manage risk and does that professionally, right? That's the only right answer here is to try to mitigate risk in this type of environment. All that being said, I don't believe wheat is going to see below $11 here. We have gap up after gap up after gap up. It's very unfortunate that I don't feel you can look at technicals on a chart like this very accurately, because there's no real price discovery to be had. If the market was going up and down between support and resistances and allowed to trade through limits, you could actually see the extreme of bullish and bearish price action here. We actually have a synthetic stop on the market that's not allowing that to happen. So we don't know, how the emotional reaction of marketplace is divulging this information in real time. All we know for a fact is that wheat is demanding a higher price than it is allowed to achieve today by being lock limit. So we'll see what wheat holds tomorrow. If you are short, definitely look to the option markets to try to mitigate that risk if you can't do so in futures, because this market does not look like it is done yet to the upside. So let's move on to corn, and where there's a little bit more to be talked about here in the May contract. That hourly chart, though, still very volatile. Over the last week, we've seen 30-cent swings in the front month futures that are paralyzing to many traders. And there's a lot on this chart, so we're going to try to remove some of it here in a second. But if I could call everyone's attention to these three open gaps on the chart, 690.75, that is just below the lows of the month for March, and where we began the month. So I would imagine that so long as that gap remains open, March is going to be a very bullish month so far. It is proving that way. Open gap down at 655, where we kind of ended in February. We started we started that last day of February off by gapping higher, but 655, called 656, the open gap below that. And finally, the gap that began this whole rally most recently at 622, the gap that had us originally crying, bull markets don't fill gaps. And we were talking about if this gap stays open, the market could run away from it. Well, look at price action and what it's proven to us so far. But it hasn't been without major setbacks. The last of which was a 50% pullback from that swing, the February low from 610 up to that 615 high. That pullback that happened very dramatically down to 662 was a 50% pullback. In all intents and purposes, the market has now rallied up to the 740, negative 23% target area for that fib. So that bull trend or that Fibonacci retracement has gotten the reaction to targets. I'm immediately now drawing up from that old entry low, stair-stepping higher, 2 steps forward, 1 step back. Now the market's taken another potential 2 steps forward. And if it takes 1 step back, the full 50% retracement from that 655 gap low, which is also the gap, a recent gap, to the recent highs at 760 here, which was a limit up move here for corn, which we will not have expanded limits tomorrow because we fell off that limit here into the end of the day. 50% move back into the 707 area could be supportive. And that's where I think I'd be very interested if I haven't really established a long position for reownership or what have you. That's the type of pullback I would be looking for to really come in and get a considerable percentage back on the board. But before then, there's other levels that are holding here and have begun a trend higher. Now I'm going to remove that fib for a sec just so we can see what's going on in the shorter time frame. We're going to go down to a 15-minute chart real quick, kind of adjust this trend line as the market lows have kind of held, but I am, suggesting or assuming some kind of trend line has formed here now against that lows, and we're in a bit of a channel higher. Off of this low, we did begin with a 50% retracement. You can see it's highlighted blue there. That first pullback, we didn't quite get to even 672, but it was a 50% pullback from where we began to the highs after the open, and that pullback, 50%. The market then went to the negative 23.6% target and gapped through and above and ran away. We went through the negative 61.8% target. So in other words, this little pullback ran away, and some degree of trend entered into a new or higher degree, right? Now drawing from the high to highs, so that old high that we drew from to the new highs that whenever they form, when there's finally a pullback that hits the 50%, now you've got a new support. 720 held, you're bullish above 711, it holds, and the market goes to the 760, negative 23.6% target. Technically speaking, the market could pull 50% back, but the fib from this low 712 swing to high, also an important level now down at 736. Intraday, just from lows to highs, the pullback we saw into the close off of limit up, that lock limit we pulled 50 back into 741. We have the most aggressive pullback, 50% level holding, in my opinion, for corn. So if you were savvy enough to have bought that dip here into the close, I think a stop below 730 is probably safe at this point. But if we do start to break down, we can't discount that corn. Again, we talked about this original 50% from 655 up to the highs. That 710 area is really the area I'd be very much more interested in if we start to break, kind of below the support we've been holding here around 730. And all that being said, corn 740, 730 kind of supportive. I'm bullish above, bearish below that 730 figure for a move now towards 780 and maybe even $8. So how do you turn that into a trade? Well, you could buy futures on a pullback here in corn. Corn is maybe the one market I feel comfortable trading futures in still, just because it's corn. I feel like it's a little more manageable, and we can use stops and risk 10 cents still in this environment. But you have to be very well timed because chasing a rally in corn and being caught every time we make a new contract high, this is the last sentiment I want to leave us with for corn, is that every time we make a new high, we seem to get some kind of 20, 30 cent pullback every day, right? New high, little pullback, new high, little pullback, new contract high, pullback, contract high, pullback. And each one of these pullbacks is 20 to 30 cents. So it's giving you every opportunity to get in if you want. But I do think we run the risk of that. Maybe a little heavier pullback, test to $7.10 to $7 could happen. If it does, that's the area I'm really, really interested in for the more kind of swing trade going forward for corn. Positionally, though, I think hopping over into the options market, if we know that, going back out to our larger time frame here, the 4-hour chart, knowing that if we're trying to do some reownership or get a strategy on, and corn has the ability, we think, to get to $8 and above, I still think there's some good option trades we can look at. I think we have to go out towards maybe July. That's trading at around around 703 here into our most recent settlement here today. $7 calls, though, going pretty expensive there. But that's okay, because I think you don't go for the $7 strike here. I think you have to go up. We go all the way up potentially to $8 for these July calls. You got 113 days on it. I kind of like this call spread because it gets you in, but there is going to probably be management required with it. In other words, rolling strikes, and that could be pulling off the upside strike. But 38 cents, let's call it 39 cents out of the pocket to buy the $8 call, 114 days. It's $1 out of the money. Very expensive for that. But we're going to cut down on that cost considerably by coming down here. We're not going to get 21 cents for this $9 call by selling that. We're going to probably get more like 13 cents for it. And that's more along the lines of what I wanted to spend, because you're going to spend 38 cents, 39 cents to buy that. Getting 13 cents back here brings your cost down to about 26 cents to own a dollar-wide spread with 113 days left on it. If corn explodes higher, for a quarter of the cost, you can still, make up that upside through July here. But like I said, I think there's still a strategy to be had in working with, looking at corn every time it makes a contract high, looking to maybe buy those 20, 30 cent pullbacks that occur for your spreading. And honestly, put on one of these call spreads in one of these pullbacks, right? If you're really trying to be savvy with it. But every time we're going and we're doing those cash sales this year, it's definitely a year where you want to go and you look at, some courage calls, if they will. I think there's more intelligent ways of going about just buying outright calls and ways you can manage, the future side of the risk that you might be taking as well. But we're in a bullish market. It's hard to do anything else or see it as anything else. All right, so let's move on to the soybeans, because I think that's where there's more opportunity in terms of spreads to really look at and more options to maybe consider. Because beans have now gone from trading 20, 30 cent ranges over the course of a couple days to doing 40 and 50 cents in the same day. And over the last week, we've seen May soybeans trade that $16.99 to $16.50 spread 7 times in the last just couple days. So our range is up and down in that range several times in the last couple days. And that kind of volatility ends up becoming a liability for most and could become a reason we end up on margin call or in even worse situations. And that drop we saw from the 1760 highs down to the 1578 lows, that day of death, as we'll call it, we came right back down in the daily chart of the May soybeans to test that's at that time this 1590 18-day moving average. That 18-day moving average is now, I think, a holy grail of line in the sand for the trend at this point. It has not proven all but one 24-hour period to lead us astray. For while we remain above that moving average, this trend is bullish and has been true since December of last year. So continuing to monitor that for the May beans here. But we're so far above our other moving averages that they're almost not worth talking about at this point, other than they're way below us, and if we start to go below 16, we'll take a look at them again, unless they come closer. So makes more sense now. Let's flip over and look at that shorter time frame chart. We're going to dial down to the hourly chart and kind of pick up where we were looking at it last week and see where we went wrong and right with it. I was very intrigued by the 1640 to 1620 area. Boy, volatility did not care. And who knew there was going to be an invasion of the Ukraine and we're going to get a news whipsaw like this? The market obviously respected this level to some extent because, look, you pull it over and it happens to be right where we came back above and now we're staying above. And I still think that that does ring true to that there is some very important consequence to staying above 1620 to 1640 in May soybeans at this point. Not only because there's an open gap now below us, that so long as we keep this open gap from 1580, to 1614 open, this is a very bullish looking chart that the last 3 days worth of price action is really just, in my opinion, a bull flag building for a move higher. It also gives us a very clear line in the sand and kind of and levels to look at 1660, 1640, 1620. We break below any of this kind of supportive area. There's not much in the way that's going to hold us from getting back down below 1600, in my opinion, and even lower below that towards a much deeper correction where if we move back to the 4-hour chart, the full 50% retracement, not that much further below that 1570 low we already saw at 1480. We fell through $2 off the high. What's another dollar at that point to do a 50% pullback for the contract low to high for May soybeans? And this volatility, you can't discount its potential and the ability for the market to do that. Whether or not it is another story, right? Because we've clearly gotten a very sharp rebound back above $16. Everything fundamentally has remained bullish. Weather still needs to prove itself here in North America. We still have drought conditions that are leading us into this planting season. South America's production is still very much in question. We haven't gotten really much clarity outside of a big question mark of they seem to be buying a lot of soybeans. China seems to be buying a lot from us too in a time of the year when we expect them to only be doing sales from South America. And nobody's really talking out of the USDA just yet about moving those numbers lower. Well, maybe the March report is going to see some big changes to the global balance sheet because we've got some questions to be answered about now European wheat production and South American production altogether from this last year. So this is what the perfect storm of fundamentals looks like. But when you have really big whales starting to swing around, big hedge funds getting blown out of positions, $2 swings in the soybeans, it also means this rampant volatility is causing massive money flows to cause huge moves in the futures. So that's where trading the futures for soybeans might now be really, really, really risky. We haven't seen a limit move and stay lock limit to get expanded limits yet, but wheat and corn have done that now. And, well, corn hasn't gone lock limit, but has been to a limit move already. Yes, beans have moved limit, but have not stayed there in the last few days, and last week of price action. But there's nothing that says we couldn't see, this continuation of volatility. But beans, I will argue, I think have had a better look at the charts in terms of price discovery because they haven't been, limited by their limit moves. We've been able to actually see price discovery happen. Beans were able to test below $16. It's very clear they didn't want to stay there as we quickly ran back above. But we've also now seen beans been very wary of breaking back above $17. So a fight over the trend is occurring, but right now the ball is definitely in the possession of the bulls. We held on, made a higher high and higher low, a meager new high for the month today. This was about as meagerly bullish, even closing positive as it can get. But we left ultimately kind of a gap level here open, and then the gap level below us open. And if you draw from the low here at 1579 from last week to the highs, arguably, that 1640 area and 1638 is a 50% support that if we traded it, I would be happy to maybe be a buyer there. But I don't know if it's going to get there because we're identifying it, and it just seems too easy, a low-hanging fruit to buy at this time. Also, soybeans have gone out the majority of the last few days at their lows, with the exception of this day here, these 2 days, I guess. But honestly, we any day we've seen soybeans go off at their lows, they seem to have a very strong overnight session. And in this last week, that strong overnight session has been very, very strong. So if today is any repeat of that, we hold above 1660 on this chart, and from what I kind of see as our current development, We put pressure and break above 1700. There's nothing above. We went through from 17 to 1750 very quickly, 1760 very quickly. I think the next push takes you to 1800 very quickly, and maybe beyond. But that's assuming we hold support and don't and continue breaking out higher. So knowing that we could, $18 and $19 are definitely in striking range from the range that we're building in, and knowing that staying above 1600 just as a foundational strike below is a good line in the sand for the trend in general. There's definitely some lines now that you can use as what I call foundational strikes to build option strategies off of. The $17 strike is the most easily identifiable one here for the bulls. It's the short-term resistance we want to break through. And it's also a strike that, if we go above it, very likely signals a move all the way back up to potentially contract highs. So, that is also 60 cents away. So whatever you pay for that strike, there's a very good opportunity for the market to get back. There's at least an obtainable price that we've been to that's 60 cents above. Not to say that you pay 60 cents more than what you're willing to for something like that, but I'm just putting my thought process out there for how I try to pick levels I'm interested in. So beginning with that theory, let's build a little option strategy here that for the next few weeks gets us that reownership. And because we think that this buildup has occurred and maybe is hitting its apex, maybe only has a day or two more of price action, we might be able to get as aggressive as looking at a weekly option. But I think for right now, looking at the Aprils with 22 days left is probably enough time. We're going to have to stomach looking at a $17 call that's costing us 35 cents right now. But knowing that over the next 22 days, there's a very good chance that if beans go higher like we expect them to very aggressively, we could see this market go 60 cents higher from there. We know that there's a potential for this market, for that option to be worth maybe 60 cents, right? And that's not a completely outrageous valuation to obtain. The market's been there. It was there 3-4 days ago. It could go back there again. Just as equally, I guess equal probability at this point, you could say that we could go down. If you look at the chart on the right, that little chart, we're smack dab in the middle. 1680 has been the, reversion to the mean of this big whipsaw that we saw. It's right in the middle of the range. If there's any question as to why we found our way back there, it's because beans had earth-shattering whipsaw and have now just reverted to the mean of that range. This is now where you can probably, either bulls or bears, as we compress in these ranges, this is where you can buy volatility for relatively the cheapest you can get it. Volatility was the highest back here a few days ago, and the market's now quieted down. If that volatility comes back relative to a few days ago, volatility is very cheap to buy. Not saying that it is cheap because it's very expensive. Market makers are still charging an arm and a leg for these options, but 35 cents for the $17 calls with 22 days left on them is finite risk and allows you to be long the market here for an option that has a really good shot of just owning outright and maybe getting in the money. I think you can do a little bit better by cutting down on our costs quite a bit on these options. And if we go down and start looking down here at some of the more further out of the money strikes, look at our chart. How high do we think, May beans might get here in that 22 days? Well, I'd be happy if I was long May beans from $17. I'd be very happy selling it at $18.20. $18.20, I think we could probably pull in anywhere between 9 to 10 cents for it. So that alone is now cutting your the ownership of that dollar or of that call spread call that's only 30 cents out of the money from where we settled today. For a $1.20 wide call spread, you're spending basically a penny a day to own it between now and a little over a penny a day to own it between now and its expiration. I feel like that is a very well-structured, low risk in terms of finite risk in this environment. But the probability of success, of course, is dictated by the outcome of the trade here and whether or not beans will head higher. And if, of course, we stay below $17, you're kissing that 26-cent cost away. But again, is it better than buying soybeans right here and risking 26 cents, which only gets you a stop down to 16.45? Barely, if we go down to test the lows of the month, you're getting stopped out on a futures position, but that call spread is still on. and could very well trade back in a few days, going up 70 cents in a day if it wanted to, as we have seen this market trade. So anyway, kind of interested in that idea, but if you don't already have some kind of position on, I know last week I was doing a lot of 1640 and 1660 foundation calls, and then we're selling 1770 and 18 and change above that. Today, this week, the strikes are ratcheted up a little bit, but the same general idea is achieved. Something 20 to 50 days out, spending 20 to 30 cents on it to get $1 to $1.50 of potential upside, and wanting it to be within 30 to 50 cents of the money, because those are very obtainable levels in this type of environment. And always with that finite risk and cost of 20 to 30 cents out of pocket. Anyway, before we get going and wrapping today, I did want to take a look at some other markets. I think crude oil will be one, lean hogs another. But before we moved out of these row crops, let's look at some of the extensions of our row crops. We haven't looked at meal in a bit, and then before we get to meal, though, let's look at the calendar spreads. And we'll begin, because we're on soybeans, let's begin with this July Nove calendar spread. Trading a $1.81 over. The last week since we've been talking about it, we've been flagging up here. It's proverbially still very bullish in its channel and its trend, still being bull spread, Make an argument here for another, maybe more aggressive trend line trying to form and hold this market, up in a channel to press highs, right? $2 over is our next big level to go through. We've, of course, taken a step back on this spread and taken a look at where things have been in the past. Our old resistance and those old highs, this is, of course, this year's calendar year spread. Last year's went to $2-3 over. So, we still have room to go, in my opinion, for the relative pricing of soybeans to head higher. Until this spread gets to $2 to $3 over, the outright contracts, in my opinion, still have room to the upside to go in the current inflationary environment. This, watching and modeling the calendar spreads against the outrights and how much they're moving relative year to year in these types of crop years, it's a great way of building in the new normal for where prices are crop year to crop year, because it's telling us, it's taking out, right, how high we have or how much inflation we've built into price over the last year, right? It's giving us the model for between crop years, how the relative price is behaving. And that is the most important price at the end of the day for the marketing campaign that any of us are putting together, because it allows us to manage risk and carry productive environments where storage is a must, and marketing is the only way to manage margins. Or in environments like this where we're all trying to figure out how high and how far can a bull market run. Knowing that these spreads are not historically as wide as they have been leads me to believe we are only still just beginning this incredible run we've seen in the row crops. And it's pretty easy to say that on a day where we're lock limit up wheat, we were limit up corn, and soybeans are still flirting with the idea of breaking out of $17. So we're going to continue to watch this, but I don't see any reason to believe that this last 3 days of price action is a major reversal signal for either the calendar spreads or the outright futures in soybeans. It certainly is a signal there's a fight over the trend happening. The market has taken a breather after that aggressive whipsaw we saw from the emotional response to the Ukrainian crisis, but now it's putting a stable footing in, and prices are looking like they want to resume an uptrend, in my opinion. So we'll continue to monitoring that developing info there for the soybean old crop, new crop spread. Corn, December corn here has not even gotten back to its contract highs. This spread does have the capability of going to $1.50 to $2 wide historically in very big backwardation. And breaking out of this old trend line and this old consolidation, this is the explosive price action that confirms that breakout of that trend line, and that this market was demanding a test of $1 over, kind of the next big psychological threshold. Now we are winding up and building, in my opinion, a bull flag, just etching our way higher here, or stepping higher, I should say. channeling higher and building for a break of that dollar figure. Above, obviously, the old contract highs I mentioned there a minute ago at $1.12 over are going to be important to consider. But $1.50 and $2 over are the other kind of more psychological thresholds to consider as we start to go there as well. But there is no cap on how high or wide these spreads can get. If we were in normal or backward or normal markets and building carry in and heading to full carry, we could be talking about where the limit is to the downside. But this environment, these are the types of years why these spreads get deemed widowmakers, because you shamefully think that they are lower risk. Yes, they are lower margin, but they end up moving and can move just as much as any of the outright futures in any given day. And if you look at some of the calendar spreads for wheat, they have been moving more than the outright futures and even pricing in beyond limit moves, as December wheat was heavily bear spread against the forward futures there last week, which has obviously changed here in the last several hours. All right, but let's move on, because I do want to touch on crude real quick, because the energy markets are obviously a big factor in playing into the demand for our corn and beans this year, or I think it will. I think it will continue to drive that ethanol demand, biodiesel demand through the roof. This administration has yet to announce any reforms to those blending mandates that we walked back on. But that's another easy ripcord and parachute for this administration to pull to help alleviate the price at the pump that we haven't seen yet. So they've done strategic oil reserve releases. If that's not enough to quell this market, which, I mean, we went to 10-year or multi-year highs, might have been 10-year highs there during the State of the Union address with crude the other night. I mean, if that's not a signal from the market to this administration to do more now about this energy, the rising energy prices, I don't know what is. But the charts are bullish. They've stayed bullish, and we've only had fundamentals to back the bullish trend in crude. And now the added effect of crisis in the Ukraine and Russian oil being taken off the market means that the U.S., Canada, we're going to be forced back to energy independence, as cheap Russian crude is now being taken out of our supply chains. It's been announced the Senate is moving to block all purchases here in the U.S. of Russian crude. That was actually, believe it or not, agricultural products and crude oil energy products were off the table for sanctions until just now, which it was kind of a joke as to what we were actually sanctioning if you weren't sanctioning wheat and oil from Russia. So anyway, they're now being sanctioned. I think the markets are responding to what the world and how pricing looks when you take Ukrainian wheat and Russian Russian oil out of the market. And that's what we're seeing on the chart, the fundamental trade. The technical trade was supporting a bull market this whole time. And now we have more technical price action to talk about. The pullback we saw back to the 67 to 64 area, that big supportive area, now broken out, gone up to its negative 61.8% lines. So now I do draw up from this high. Let me get up the right tool. From the high here at 85 to the new highs up at 116. 100 area becomes the next 50% pullback of interest. It's also the highs from the month of February, and a key psychological level that I think we're probably going to end up staying above. But as we press above 100, certainly above 110, and urge into 120, we also run into the reality and the fundamental picture of more pumps globally being able to be turned on. Wells that were maybe turned off, not capped, but the spigot turned down and dialed back in production in order to keep the reserves in the ground, the cheapest place, by the way, to keep strategic oil reserves, which the United States has done a great job of by buying cheap Russian oil over the last several years instead of pumping oil out of our own ground. But now it is time to probably turn back those spigots on, right? Getting that oil back into production is, from my understanding, very quick and easy from the wells that it's been pulled back on. And we're at a price in oil that, it's my understanding, is pretty much profitable to start drilling new wells in many places of the world. So economically, the oil market is being incentivized to increase production here. And economically, the oil producers will probably increase production because that's just what they do. It's their job to do this, to take advantage of these high oil prices. So I do think we're going to start to run into what we would refer to as commercial selling up here. I think the price action in the last 24 hours is the start of some of that volatility coming in, just because we're at prices where nobody, if you're an oil trader at Chevron or any major conglomerate, why would you not be doing something to try to take advantage of 110 barrel of oil here? These are the best prices you've had for your products. And likewise, if you're a cracker, if you are in the gasoline production, you're probably urging, or really now, you're probably very you probably have some urgency to buy the barrels you need on a big dip if they have it. So I think we're going to see a big fight now over a wide range as commercials establish where those where the gasoline producers want to end up buying crude and are comfortable buying it, in this environment. And then, of course, you're going to see a lot of selling pressure at these prices, I think, from commercials willing to sell into these prices. And we're going to start watching the calendar spreads into those summer months for crude to see if some of that bear spreading happens into those months, and watching the dynamic there. I'll have to do a completely different video on that, but that is something to come here, and we will be discussing that here in the future. And last but not least today, I did want to look real quick at the lean hogs in the April contract. So I think we've started to put in a little bit of a base here. We've got a multi-day trend that started higher. Today, we traded back into the 50% retracement from this swing low to high here, okay? I think this is the start of a little bit of a stair step higher. Lean hogs in the last few months, if we take a step back to that daily chart, you've seen here since the start of March, we've been holding this 101 to 103 support. That seems to be, in my opinion, where this market's trying to base from. I think we're also holding a more aggressive here extended long. We already had one this high, the highs basically here from January to this high at 107. It proved a 50% pullback, held in the negative 6 to 1. I'm giving a little bit of leeway here, but that same high to high pattern played out here, pulled back into that supportive area. We're getting a reaction. If that reaction takes us higher, I do think we have an upside target towards 116. So if you weren't going to buy lean hogs here with stops below 102, I've actually had been pricing out all week and still like this strategy. The 110 strike is kind of where I'm looking for it, but the 110, 117 call spread in the lean hogs. This is a strategy in April hogs for the next 44 days. We were, I was getting this done anywhere between 1.4 to 1.5. And it's a limited risk, right, call spread, where we've been up to 110. You're having to pay $245 out of the pocket for the 110 call. But then we're turning around and we're selling that 117 call and bringing in $1. This is basically exactly what I've been doing it at for the last couple of days. It's been worth a little bit more. It really hasn't been worth less than this. But it's going for 145. So that's, you're spending $245 to buy the 110 call, selling that 117 for $1. $145 out the door. You take that option price of 1.45, multiply it by the $400 per option contract. It's $580 cost. And your potential upside here is if we go to 117 and break above that contract high in the lean hogs, your potential upside is that full $7 in the lean hogs. Multiply that by the 4, that's $2,800 potential upside, $580 max risk, 44 days left on it. There, we just constructed a bull spread opportunity, a call spread in the lean hogs. Now, likewise, though, we start to break below 103. That 103 put in the lean hogs, or 102, excuse me, and the 101 put, a little expensive here at 2.5. I actually also like the idea here, if we don't get this, if this spread doesn't take off here soon, probably getting out of that. And lean hogs for producers, if you're looking to actually put a floor in on price here, I think you can afford to get, over the next 44 days, a floor in here for right at $1 here for 220, and turn that into a put spread. You can get $5 or $6 of downside protection from there, all the way down to 94 for basically $1 cost, because you can pull in 92 cents by selling that put down at 94 and have on that $6 wide, $1 94 call spread for only $1 here, for just over $1, which is about $400 for protection on a deeper pullback, and that protects you for, in my opinion, a pullback into that 50% level where I'd be a buyer again back down around 95 in the April lean hogs if we get there, and that full 50% pullback. Sorry, I'll pull up that other chart real quick for you so we can take a look. It'll flip up here in a second. There you go. And that's basically that 194 spread is designed to make money on a downside move down into that 95, 50% level where I'd want to probably establish a long position for a move higher. But we'll see what happens. I think we'll continue higher in the near term as long as we're above 103, and watching that 110, 117 call spread for a good way of getting some finite risk to the upside in the near term. So, all right, well, thanks for joining me, everybody. It's been a blast. I hope you guys have, take away something from this about volatility in the marketplace, how to try to cut down on some of that extra volatility premium that the market makers demand for options, even if it's on the put side in a bull market. You can turn those into put spreads in the near term to cut down on some of that cost out of cost pocket. Yeah, you cut down on your delta, but remember, volatility is higher. So even though the delta might be low, the amount the market's actually moving, the range on the day, is bigger when you consider even with that smaller delta. So the amount of money you can make or lose in a day may actually be bigger because of that, relative to days where it's not moving. I'm not saying relative between owning a call or a call spread, but I'm just saying that on relative to days where we don't have this volatility premium built in. So love to have more in-depth discussions with you. You can always reach us over here at Zaner at 312-277-0110. Find me on Twitter, on Facebook. Shoot me an email, dhussey@zaner.com. The whole team will be down at Commodity Classic next week. I hope some of you can join us. If you're going to be in attendance, shoot me a message. We'd love to meet up for drinks or a bite to eat. We'll be attending, of course, some of the banquets down there, and generally going to meet, rub shoulders, say hi and hello to some of our clients, and of course meet any of you looking to actually put a handshake to some of the faces and voices you hear on social media. So have a great day, everybody. Thanks for joining us for this week's Strategy of the Week webinar. I'm Dan Hussey from Zaner Ag Hedge, and we'll be back with you as price action develops.
My only issue is that with that is that the whole team won't be, and you should let them know.